Hello, good afternoon, everyone. I'd like to welcome everyone on to this spring statement overview this afternoon. It was great to see so many attending these events. It's great to have you on board this afternoon. Now, firstly, if anyone has got any technical issues throughout this afternoon's event, please do feel free to contact us using the chat function. And we will be having a Q&A session towards the end of the event this afternoon, so feel free to post your questions in to the Q&A box as we go through the event, and we'll pick up on these questions as we go. So my name's Carl Taylor, and also on the panel this afternoon, we've got Joe Brewer, who is consulting partner at Oldfield, spends most of his time working with clients to help them grow and prosper. So hello, Joe.
Yes, good afternoon to all, and thank you for joining this webinar this afternoon.
So the Chancellor presented his spring statement to the House of Commons earlier today. That was actually 12:30 this afternoon. He started his statement. And so really this afternoon's event is really just about unpacking what that statement actually means for small and medium-sized businesses. We really want to unpack the key points so that you really get an understanding of what it means for you and what it means for your business, and you can take action on anything that's come up this afternoon. Because I guess we're in an interesting environment. So much has changed since the budget statement that the Chancellor made in autumn 2021. We've got the Ukraine conflict, and the impacts of that has really created a backdrop of uncertainty from an economic perspective, and it's put pressure and piled more uncertainty on for supply chains. It's caused an increase in oil prices, and all of this has had quite a major knock-on impact on inflation. So, the spring statement is not actually a budget. It's not meant to be a budget. It's strictly just intended to be an update on the UK government spending plans off the back of updated forecasts from the OBR. But there were some quite important announcements from today's statement. We really want to highlight those and unpack them and explain them to you. So just to go over the agenda for this afternoon's event, we're going to kick off with a brief economic update. We're just going to highlight some of the key economic indicators, some of the key numbers, look at what they've been doing over the last few months, and also what the new forecasts are. We're also going to touch on some of the business tax changes that were announced this afternoon. Then we're going to go on to some of the personal tax changes that were announced, and then we're going to have question and answer session. As we said, do feel free to post your questions in the Q&A box, and we'll pick those up as we go through and do our best to answer those at the end. So I'm going to hand over to Joe, who's going to give us some initial points on the economic update. Thanks, Joe.
Thank you, Carl. Yes, I wanted to touch on two features of the current economic landscape, you might say. Firstly, perhaps the most important is inflation. So we're currently experiencing what's called a global inflation spike. And as the slide shows, all of the major developed economies are really experiencing the same. So you can see on the slide there that USA, Canada, the Eurozone, and to some extent Japan, all experiencing very much the same as we are in the UK. You can see the red line there, the UK, we're very much in the thick of it, experiencing this inflationary spike. So if we move on to the next slide, we'll concentrate on what's happening in the UK. This is data that's actually just been released today, so it's quite interesting. And it shows that inflation is currently running at 6.2% in the UK. Now, just to set the scene for that, that's the highest inflation we've experienced since 1992, so that's 30 years. So it is quite significant. And it's also interesting to note that the target for inflation is actually 2%. So a small amount of inflation is actually good and healthy for the economy. And you can see over the last few years there that are on the slide, it's been around 1.5% to 2% quite consistently. Then it's gone down to sort of very low levels, and it's now on the increase. So we're up to 6.2%. And the prediction is that this year, that inflation will be 7.4% on average for the whole of 2022. So for the whole of this year, we can look to a figure of 7.4% inflation. That's quite significant. The forecast predicts that it should be returning back under control by 2024, maybe sooner. However, it is worth noting that if the current Ukraine crisis is prolonged, it might cause inflation to stay higher for longer. There's obviously an element of uncertainty there, which we're all well aware of. So just a bit of a takeaway from that, I suppose, is with inflation at its highest levels in 30 years, we can't really ignore that. And a couple of suggested actions for business owners might be to take advantage of the current climate of price volatility. Our customers will be receptive to price increases. So take advantage of that, increase your selling prices, and also be realistic in increasing staff salaries as well to compensate staff for those rising costs. So that's particularly pertinent, that second point as to staff salary increases. I think it's particularly pertinent given the current pressures on the labour market, shortage of labour and the challenges that brings. So the challenges of recruiting and retaining staff in these times of extremely low unemployment. We'll be looking at those numbers later in the presentation. The second feature I wanted to touch on is interest rates. You see there's quite a simple slide there, but we're looking now at the UK bank base rate. So you can see from the slide that the bank base rate is on the increase as well. It increased to 0.75% last Thursday. And that's, just to put that in context, that's back up to the level it was just prior to the pandemic. So you can see that on the slide, 0.75 in 2020 prior to March. And then it's gradually easing back up to that exact same level, 0.75%. The expectations for the rest of this year are obviously harder to predict, but the slide shows that there's a range there between the predictions. So you've got banks such as HSBC predicting a rise to 1% in the base rate by the summer of this year, and then holding at that level, leveling out. The financial markets are talking about rates peaking slightly higher, as you can see from that market path and prediction there, maybe going as high as 1.9%, and then starting to fall again. So there's a couple of indications there that we need to pick up on. Further interest rate increases are obviously likely. And whilst these rates are higher than we've seen for the last few years, it appears that there's no real cause for alarm in that data. It's only data, of course, and predictions. But our comment would be to make sure your business debt level is under control, your gearing is right, and that you've got plenty of interest cover. So that means you've got plenty of profitability, more profitability, obviously, than your interest payments are likely to be, given the rises on hand. So I'll now hand back to Carl, who's going to run through some further economic projections for us. Thank you, Carl.
Thanks, Joe. So that's really given us good background to where inflation and interest rates have been going over the last few months and what the expectations are. I guess on this section, I just wanted to fill in with a couple of other key economic projections as well, just to give the complete picture, or a more complete picture of what the expectation is over the next couple of years. So this table that I've got on the slide here really just summarizes some of the key economic forecasts for 2022 and 2023. And this data was actually updated this morning with the new forecasts that were published today. So you can see we've got 2022 and 2023 forecasts there, and you've got the actuals for 2021 there on the left to give us some comparison, give us some context. So the first line there, you've got GDP growth. So that's just the growth in the whole overall economy. And you can see for 2021, we saw growth of 7.5% there. And you may have picked up, the Chancellor made a bit of a point of that was actually the fastest growth in the G7 in 2021. However, you've got to remember that was really a recovery from COVID, because actually the UK experienced the biggest drop in GDP in G7 as a result of COVID, as well as experiencing the fastest growth in the G7 in 2021. So you've got to bear that in mind, that's partly just recovery from COVID. And you can see then, as we move to the right, the expectation is 3.8% growth in 2022 overall. So that growth projection there has been sort of revised downwards since the previous forecast that we saw, but it is still positive news for growth overall for 2022. If the growth in the economy overall is going to be nearly 4% this year, we will need to make sure we're tapping into that growth, tapping into our share of the growth in the overall economy in 2022. You can see it kind of leveling off, decreasing slightly in 2023 there to 1.8%. The inflation point there, Joe's already given us a good background to that. So overall annual inflation was 2.6% in 2021. Obviously, it did increase quite a bit in the back end of 2021, particularly sort of Q3, probably particularly Q4 2021 saw the sharpest increase in inflation. And then obviously the big one is that it's expected to be 7.4% on average across 2022. But then dropping off slightly in 2023, and then it may be back under control by 2024. So an interesting journey, I think, on inflation over the next couple of years. Unemployment rate, you can see there, 4.5% overall for 2021, and actually very low right now, 3.9% for 2022. And there's a slight increase in 2023, but overall showing really quite low unemployment rates over the next couple of years, which means we probably should expect the tight labour market that we're experiencing to continue. And that really just, highlights again what Joe mentioned earlier about the importance of having an effective staff retention strategy to really retain talent in our businesses. So then you've got the UK bank rate there, the interest rates, and Joe's really touched on that. Obviously 0.25% at the end of 2021. We've already had an increase to 0.75% in last week. And then I think the next update on that will be in May. So be interesting to look out for that, see what happens in May. But then the expectation of banks like HSBC is that we may see rates at 1% going forward. So that really just covers off on the economic update, the key numbers there, key trends. So we're now going to turn to the announcements from the the actual announcements from the spring statement, the actual announcements that the Chancellor made. And as mentioned, we're going to split that into two sections. The first bit is going to focus on the business tax changes. And then the second section, we're going to be going over the personal tax changes that were announced in today's statement. So we're going to kick off with business tax changes. And the first thing to say was really more of a confirmation than a new announcement. But the Chancellor did just confirm that his previously announced health and social care levy is definitely going to go ahead from the new tax year onwards. Maybe there was a bit of speculation ahead of today as to what was going to happen with the health and social care levy because of the kind of increase in inflation and increased pressure on people's real incomes. But the Chancellor has confirmed that it's definitely going ahead. And just as a reminder as to what this actually is, it's a 1.25% increase on most types of national insurance contributions. So employers' national insurance, employees' national insurance, self-employed national insurance, all of those rates are going up by 1.25 percentage points. And also dividend tax rates across all bands are going up by 1.25% from the new tax year onwards. So that's really just a confirmation that that's definitely happening. However, alongside this, he did announce some different measures that will actually help to mitigate this for both employers and employees. So the first key point was that the Chancellor announced that the employment allowance is going to increase to £5,000 in the new tax year. So it was £4,000 in this current tax year that we're in, and it's going to increase to £5,000 in the new tax year. So just a little reminder as to what that actually is. The employment allowance is a reduction in employers' national insurance, which all businesses benefit from. And it's a really welcome £1,000 reduction in national insurance in the new tax year. I think it will help to offset the increased costs for businesses due to the introduction of the health and social care levy. So it's just a bit of a mitigation, really, of the health and social care levy that's coming in the new tax year. It's probably worth just mentioning that obviously extremely small businesses employing sort of say one or two staff, they probably won't see any benefit from this because they wouldn't actually be paying any employers' national insurance anyway. But overall, it's going to be a welcome tax cut for most businesses who are employing, more than 2 employees. So that's a welcome announcement. Probably just one thing to say is that if you are eligible for the employment allowance, which most employers would be, you do need to make sure you definitely claim the employment allowance through your payroll. It's just worth you double checking with whoever's processing your payroll for you. That's definitely being done in the new tax year. Second key announcement I've got here, which actually does impacts individuals as well as businesses. Part of the Chancellor's announcements included measures to help sort of mitigate the significant increase in the cost of fuel that we've all experienced over the past few months. I think if you look at this slide here, this slide shows average petrol and diesel prices in pence per litre, and this just shows the trends since 2004 across here to the left, and we can just see the overall trend there. So you can see a fairly steep increase in the far right on this graph. Overall fuel costs shooting up quite significantly over the last few months. Probably what makes it seem so extreme is that overall fuel prices were actually quite low during the pandemic, particularly earlier on, April, May, June 2020, when the demand for fuel was actually very low. No one was really traveling anywhere, and fuel prices actually came down quite significantly then. But then we're seeing quite a steep increase now. So the government have stepped in and announced a reduction in fuel duty. So fuel duty is going to reduce by 5p per litre, and that's going to come into effect from 6 p.m. tonight. So probably makes sense for everyone to wait till 6 o'clock to fill the cars up with fuel. Just to put that in context, if you take a example of a sales rep, say doing 20,000 miles in a year, it could be worth in the region of £130 saving per annum, this reduction in fuel duty. So it's not exactly huge, but it does go some small way to helping sort of relieve the pressure created by increased fuel costs. There were some other elements mentioned in the overall context of sort of business taxation, and there were some mentions of reforms on R&D tax, which have already been mentioned anyway. But and then there were also some mention of capital allowances changes from 2023 onwards. And the Chancellor really just said that there's more going to be announced on this in the autumn budget. So we'll see some more detail coming out, hopefully, in the autumn budget, and we'll be keeping everyone in touch on what those changes are and what they actually mean for businesses later in the year. Obviously, there's been some success with the introduction of the super deduction, which is in place at the moment until March 2023. That's been quite a welcome scheme for giving an increased tax deduction for capital spend. And I guess the Chancellor's wanting to kind of continue some momentum on that. So it'll be interesting to see what form that takes in the autumn budget later this year. So now I'm going to turn to some of the personal tax changes that were announced and mentioned. I'm going to hand over to Joe for that. Thanks, Joe.
Thank you, Carl. So, personal tax changes. Interestingly, we've got a couple of personal tax changes we wanted to highlight, and they both amount to personal tax cuts, so that's good news. Firstly, the national insurance threshold is being aligned with the personal tax-free allowance amount from July this year. So that's actually an increase in £3,000 in the amount that you can pay through payroll free of national insurance. To put that in context, it amounts to a saving of about £330 per year for most employees who currently pay national insurance. It's also helpful to company directors who can take more salary out of their company free of national insurance. So company directors on this webinar this afternoon might want to consult with your accountant about the optimum level of salary to pay yourself for the next tax year. So that will be more than obviously previous tax years given the new threshold for national insurance. So that's a good move forward. It's a simplification and a tax cut. Secondly, this is a surprise one. I didn't see this one coming, but an announcement for the first time in 16 years, income tax basic rate will be cut to 19%. So that's a reduction from 20% down to 19%. However, we've got to wait 2 years for that. That comes in 2024. However, that's good news, and that I think illustrates that the Chancellor's kind of close to the need, helping. Principally, it helps the sort of low to medium mid-range employees, those that are on lower to mid-range salaries. It's kind of another help to those people, those families. So I think that's good news. Hopefully that's helpful just to get that brief overview. Back to you, Carl. Thank you.
Thanks, Joe. So just a couple of personal tax changes there that it's worth everyone knowing about. So just before we move on to questions and answers, I just wanted to mention that we are running another event on Thursday, 28th of April at 1 o'clock, where we're going to be running through, going to be going over some of the real-time trends that we're observing, or that we've observed from the Q1 2022 performance, helping you benchmark where you're at with overall trends. There'll be a link coming through following this event that you can book for that, where you can book for that event, and we'll be really looking forward to seeing you on that next webinar. So we're now going to move on to questions and answers. So we've had some questions coming through, which is really good. Just pull those questions up now. So just got a question here on the national insurance thresholds increase. So when is this coming into effect, and is it going to be backdated for the whole tax year? So that's a good question. So this is the increase in the national insurance free threshold. So the answer to that is no. It does actually only apply from the 6th of April onwards. So basically, employees will be taxed at the sort of previously announced levels. They'll pay national insurance at the previously announced levels for the first 3 months of the tax year, and then from 6th of July onwards, the new thresholds will come into play, and it will effectively be the same principle for self-employed persons. They'll just get 9 months worth of the increase in the national insurance free thresholds, so they'll get the same benefit ultimately at the end of the year when they do the tax returns. Got another question here. What do you really think will happen to interest rates going forward? Joe, I don't know if you've got any comments on that one.
Yeah, it's a good question, and of course, none of us would pretend to have the answer to that. I think we noticed on the slide that there's a range of projections there. I think it's worth noting as well that obviously the current crisis in Ukraine will have a bearing on it. I think what the economists are saying is that the central banks are perhaps more reluctant to increase interest rates in a crisis. So we need to bear that in mind, that that's probably holding it back. The previous forecasts for interest rate increases might have been slightly higher. So whilst we can't exactly define what those interest rates might be, the initial indications we've got is the base rate is going to be between 1% and 2%. That's about the best we can estimate at this stage based on the data that's available.
That's good. Thanks, Joe. Got another question here. Is there any change to the business mileage allowance payments? So this is where an employee uses their own car for business use, and they can claim 45p a mile for the first 10,000 miles, and then 25p a mile thereafter. Question about that, because these rates haven't changed for over a decade, and no longer cover employee running expenses. What's the solution? It's an interesting question, and yeah, the rates haven't changed for a long time. I think there's probably quite a few people campaigning for those rates to be increased. You're really going to have to wait till the budget to see, which will obviously come out later in autumn, to see if there's going to be any other changes to that. As far as I'm aware, it's still sticking at the 45p and the 25p a mile rates. In terms of the solution, I mean, probably not the simplest solution, but I mean, it's a question of looking at what type of car you actually have and whether you can get a more efficient car, or even a hybrid or an electric car. But I don't know if Joe's got any other comments on that.
Well, I think that covers it, Carl. I think I'm not aware of any changes to those rates. As has been pointed out, they are somewhat out of date, but I guess it's just another of the government's ways of trying to encourage a transition, isn't it, to hybrid and electric vehicles. I think that's the point of it.
Yeah, exactly. A question here. Do you have any comments on taking out new mortgages at present, fixed or variable rates? Don't know what you say to that one, Joe.
I think the right answer is that we're not mortgage advisors. I think that's the first answer to that question. However, if you look at that slide, if you remember that slide that we showed on interest rates, how low they've been and how low they are really in the whole context. Some on the call might be old enough to remember the 70s and 80s where interest rates went to 15, 18%. So I think that might just be a hint as to what might happen. They could go high again. So based on that, I think you might make a judgment as to whether you want to fix part of your interest rate. But unless you've got anything to add to that, Carl.
I think that's good. I think it's a good answer. I think there's just one question here about exchange rates. What's the expectation on exchange rates going forward? Well, I think any forecasts that we've seen don't show any dramatic changes, but you'd be advised to consult with your foreign exchange provider and advisors to discuss strategies to minimize risk in that area.
So you might want to look at hedging or something of that type to make sure that you're not exposing yourself to risk. Carl, do you think so?
Yeah, exactly. But I think you really want to speak to your foreign exchange consultants or providers on that point, really.
There is another question I'd picked up. When in the year can you claim the employment allowance? Remember the employment allowance of £4,000 per annum. Now that's increased to 5,000. When does that actually apply and get claimed? I think the main thing is look at who's actually running the payroll for you. If you're running your own payroll, it may be in the payroll software you've got, maybe just as simple as ticking a box within that software to actually claim it. If you've got outsourced payroll, speak to your payroll provider. That should come through early in the tax year. So, for example, if you pay, let's say, £20,000 a month in tax, in PAYE and national insurance each month through, obviously, through your business, normally you would expect that to be claimed in the first month or two of the tax year. So your first payment might be only 15,000 rather than the usual 20. So it's claimed early on in the tax year. It comes into effect straight away. Obviously, for smaller businesses, it might take longer, more months before you can use that all up. The main thing is to get the software right, isn't it, Carl, and make sure that that's working properly and that it is being claimed.
Yeah, that's it. Yeah, it's good. So basically, as early as possible in the tax year, basically, is normally when you claim the employment allowance. Good. I think that covers all the questions we've had come up. We'd like to thank everyone again very much for joining us on today's event. It's been great to host you, and we look forward to speaking to you again soon. We have got our contact details on slide there. If anyone does want to get in touch with us on anything we've talked about today. Thank you very much for joining us, and look forward to seeing you again soon. Thank you.